Hello, everyone, and welcome back to the Hub channel. Brandon's out today, so I'm sitting in for him. And joining us, as he does every week for the Delta Neutral Show, we've got Jeff Beamer. How are you, Jeff?
I'm well. How are you today?
Very well, mate. And a bit of an interesting day in the market, maybe a little bit quiet. How did you see things?
Exactly. Quiet as you get ready for a busy week full of earnings, full of economic reports. There's a lot going on this week.
Yeah, and I know that retail sector's coming up soon with all of their earnings announcements, and so that's going to be a real interesting one to sit through.
Exactly right. Yeah, we're really focused on the consumer this week and looking forward to seeing results as we get through the week.
Absolutely. Now, we'll jump into it in a minute. And I know everybody watches this show to get your trade each week. So just to touch on what we're going to run through, we're going to look at Jeff's trade from last week because that was really, really successful. And then we're going to have a look at the US market update, and Jeff will give us his outlook on things. And then we'll come back and look at Jeff's trade for this week. So with that said, Jeff, let's jump in and have a look at your trade from last week. How did it fare?
Yeah, I wanted to pull up the chart here. We focused on Affirm last week. AFRM is the symbol here. And I got the chart up with an arrow pointed not only at the earnings date, okay, so you can see that the stock gapped up on earnings and traded higher. In fact, on the open, we really pressed higher, and kind of watched the market, and just as it started to sell back off, we exited our trade and locked in a $100 profit per spread, which is a 28.5% return on risk in just 3 days. I like those types of returns. What do you think?
Yeah, fantastic trade. And, I know we say it each week, but if people are enjoying these kind of trades, they need to get over to Ewo Trader and follow you, because you do a ton more of these trades for subscribers over at Ewo Trader. And in fact, we were talking just before we went on air, and I noted a few things down. So far already this month, the breakout strategy has had 10 out of 12 winning trades. So it's like an 83% track record. You've made $2,500 for subscribers. You put five trades out last week, which were all winners. And I think you said you've done another couple of trades already today. So it sounds like you're really busy over there.
Yeah, busy week. We're still in the kind of the heat of the earnings season, and lots going on. So love this time of year.
And your subscribers over there must be very, very happy. If you want to know more about what Jeff does over at Ewo Trader, there is a guide that you can download. So maybe we can put that up on the screen for anybody. So if you navigate over to ewotrader.com/straddle, you can download the guide and learn more about what's Jeff doing with his earnings breakout strategy. So grab that. All right, Jeff. So should we get on and take a look at the US market and how you're seeing things in some detail?
So talking about the top headlines this week, we're looking really still at the consumer. Last week I talked about the consumer. That's where I was focused on. And this week we have several warning signs for the consumers, really beginning with economic reports. We have consumer price index, the CPI coming out tomorrow morning, as well as core inflation numbers, the year-over-year numbers. Then on Wednesday, we have the producer price index, also known as PPI, and retail sales. And finally, on Thursday, we have initial jobless claims in the morning. Now, one of the key things about these reports is not in the report themselves, but in the revisions. Okay? The government is notorious about padding the initial numbers, but they bury the revisions later in the report so that it doesn't seem as bad or as good. Sometimes they'll highlight the good, but when it's not so good, they'll try to bury that. So pay attention to not only the numbers themselves, but also in any revisions that we have. And not only that, but we have earnings, a lot of consumer names in earnings, which I'll talk about in just a moment. But let's jump over and talk about the really the broader market. Let's start with the Spider Index Trust, SPY. Really kind of a mixed day today. We were somewhat flat. I've identified that this 440 level is pretty critical. We closed today, well, the high is right at 440, the close, and then today's close is 440.19. So we've closed for 2 days right at this 440 level. What I'm looking for is a convincing close above this level. You can see that 440 is acting as some resistance. We need to bust through this. And the good news for the bulls is really how this looks with when we throw in the Heikin candles. I was a little concerned going into the end of the week that we got what I call a little wicky, as you see the wicks on the tops and bottoms of the candles. But today's candle, again, solid green, no wick on the bottom. I wouldn't be surprised if with any halfway decent earnings reports coming out and any halfway decent economic data that we push above 440 and we start to climb higher. Now, interestingly enough, the NASDAQ showed a little bit of weakness today, okay? But with the Heikin candle, you can see that we're still very bullish on the Qs. Let me show you the candles, and this is why our headline says that we're a little bit we kind of came off a little bit. You can see the small little candle today, a little bit of indecision, a little bit of anticipation for these earnings and these economic reports. The Russell still under pressure as we kind of look for some direction from the small caps, which right now are headed down towards my target once again of these previous lows down here around the 160 to 162 level. Okay, so IWM remains under pressure, and those really are the main. I mean, Dow is still doing its thing. We don't really need to kind of belabor the point of the U.S. markets. It's just that the bigger names, those big seven, which have been holding up the Spider and the Qs, are still in play. The Russell and the small caps are still under pressure. That's really kind of the name of the game right now. Now, as we go through and take a look at crude oil or the oil markets, we have found some support down here on USO. In fact, if you look here, we came right down to my long-term moving average, which is the 161 period moving average, okay? And we bounced right off of it. Amazing how this happens with some of these Fibonacci-based moving averages, okay? My short-term moving average is the 21 period. My long term is the 161, and you can see we came right down to it. We held, and I commented on this that we might find some support here, and sure enough, we have bounced off of this and kind of moving a little bit higher, at least retracing some of the move, some of this downward pressure. I would not be surprised if on this move here, if we did just kind of a typical pattern where we bounce up a little bit and then we start selling off once again, depending on, of course, many economic factors. Okay. If the consumer shows any weakness or whatever, we could see some more pressure in the crude or oil markets. And XLE, as just kind of another example, it found some support as well at this 100% extension off of the zigzag pattern here that I have on the chart. All right. So it's found some support. So we're seeing a little bit of a rally in crude oil and the energy space. Definitely something to watch. I wouldn't be surprised if we, rally back up here on XLE towards the 87.5 number, which is right up here at this previous pivot. That is definitely in play if we get another follow-through day on the energy sector. Now to precious metals, taking a look real quick at gold. Gold has found some support here at my the line in the sand that I drew. We broke through it on Friday. Today it rallied back through it, which is an indicative, of a support level. Okay, and we will see how the dollar reacts. If the dollar shows some strength, we could see some continued weakness in gold. Otherwise, this might be just a little nice basic pullback in anticipation of a much bigger move. You can see here that I've drawn my Fibonacci retracement on here. We've pulled back, look at that, 38.2%, right on the number. Okay, amazing how this kind of plays out sometimes. Okay, good support area. If you're looking to go long, maybe gold, what I would do here is pretty much just draw a line in the sand, maybe just a trend line, or pay attention to your moving average, whatever you're using, and saying, okay, as soon as we cross that line, then I'm going to go bullish. But right now, we're a little weak in gold, and the same thing probably in silver. Yep, kind of still the same thing. And I would bet that the Fibonacci retracement here kind of works out the same. I like to draw mine from close to close. And so if I do close to close, then we're just above that 61% retracement area, kind of in no man's land, but look at that 50%, we're right at it. So same thing with silver. So lastly, we're going to touch on bonds and interest rates. And really, TLT, which is the long end of the curve, this is the 20-year plus treasury. We rallied last week. We rallied higher, meaning, and interest rates were dropping a little bit, but there was some interesting underlying themes at play here. Okay, so this is TLT. It's really kind of paused up here, formed a small little wedge, and we'll see we'll see if we can break out of that, which direction we're going to go. If we look at the 10-year, kind of the same thing. You can see I drew my line in the sand. We gapped down below that today and then rallied back up towards it. Are we going to break out of this? This is almost the exact same thing. You can see here this little bitty pattern that we have going on here. We're kind of building up the potential to move either way, up or down. And of course, the interest rates will react to that. If we're looking at the rates themselves, which is TNX, this is the 10-year note interest rate, you'll see that we're kind of poised to maybe move a little higher here. And one thing I'd like to put on for you here is my Elliott wave count, because it shows a beautiful wave 4 pattern here, which is not very good for really the market. We're looking for, according to the technicals, we're looking for interest rates to begin to rally higher, which would push bonds down. And that is the environment that causes a little bit of stress in the markets. So lastly, I'll show you the short end of the curve, which is SHY. And this is important because you'll notice that SHY really isn't moving. Now, why is this important? Again, SHY is the 1 to 3 year US Treasury bond ETF. This is known as the short end of the curve. So what I'd like to do is show you a chart of the difference between the short end of the curve and the long end of the curve. This is the 10-2 Treasury spread. So the difference between the 10-year and the 2-year. We have been inverted now for over a year on this. And anytime the 2-year pays more than the 10-year in this example, this does put pressure puts pressure not only on the bond market, but also on the capital markets as well. You can see here that the spread, you notice it's dropped a little bit, okay? That means the we are widening once again. We had a very nice trend moving higher here on this chart to where we were kind of closing that gap, that inversion. The 10-year was catching up to the 2-year, but the problem was the 10-year was rising and the 2-year was not dropping. That is the critical thing here. And now the spread is widening once again. This is commonly known as a leading economic indicator that when we are inverted like this for an extended period of time, it's usually a 12 to 18 month advance notice of some severe economic challenges. Well, we've been talking about that. We all know what's happening to prices overall. We all know what's happening to the consumer with inflation. We can feel it. If you've been listening to any business news, you hear what's happening in housing and interest rates and 30-year mortgages. Everything's going up, 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 up as it relates to interest rates, and that causes problems with lending and cash flow. So, that's really a general summary of what's happening in the bond market, as well as our capital markets. Capital markets, meaning the equities, are waiting for earnings and these economic reports. The bonds are kind of waiting for some of these numbers as well. I mean, the Fed's going to be looking at CPI. They're going to be looking at PPI. They're going to be looking at jobless claims. They're going to make a determination on interest rates for their next meeting. We'll talk about that in a few weeks as we get closer to that date. So really, that's it as far as the markets go. What we want to do is really look forward to what's happening this week. And what's happening this week are earnings. And JP, we like talking about earnings, don't we?
Yeah, absolutely. I mean, just coming back to the market there, basically, to summarize what you're saying, it seems hurry up and wait is the order of the day. And it seems that waiting on some more interest rate direction is really going to drive everything. I noted today that we had a mixed bag. The market overall was down, the Qs were down, but the Dow was up.
Right.
A lot of those indices are following a similar pattern. A couple of weeks back, it seemed like the Qs were the leader. Now it seems like maybe the Dow is the leader, but we still haven't got an upside break in the overall market. So I guess it is going to be that interest rate picture that probably gives us some impetus for that movement to finally occur.
Right, exactly right. And we'll get that in due time, but that's why this week is so important with all these economic numbers. They could be market movers and maybe not. Maybe we just kind of maintain. We could see the market rally, but this is where earnings come into play. This is truly a stock picker's market because we've had a lot of stocks selling off. We've had a very few that are kind of still bullish and running away and kind of supporting the overall market. But let's take a look at this week's earnings. We have a lot going on, and we're on the backside of the earnings season. Okay, still a lot to talk about, but this week is really, as we mentioned earlier, all about the consumer. Okay, so the consumer, some key stocks to focus on tomorrow. We have Home Depot reporting. That is obviously a kind of a bellwether of economic activity. Okay, Wednesday we have Target, Advanced Auto Parts, Cisco reporting. But then Thursday is kind of Retail Thursday. We have Walmart, Bath and Body Works, Ross Stores, Macy's, and then a tech company, Applied Materials, which is actually one of those nicely bullish stocks, or has been lately. But all these companies have earnings this week, and it's going to be very, very busy. And I've identified one of these that I'm really going to focus on for this week. And so this week, our trade, or the stock that we're going to focus on, is the Bath and Body Works. Okay, so let me pull up that chart here real quick, and then we can take a look at the image here. So already the stock has been selling off. It's had some nice volatility. Now realize this is just a $30 stock, okay? But the trade that I picked, I did pick this as my breakout trade for this week because the options were priced that historically this stock has a estimated move around earnings, and for some reason the options are priced for a, well, let's just say it gives us the opportunity to make some money if the stock breaks out. The pricing is right where we need it for this to occur. Typically, the stock does gap around earnings, or it tends to run in one direction or another. So if we take a look at the image that I have for Bath and Body Works, what I'm doing is essentially putting on a strangle where I buy a call and buy a put at two different strikes, but the same expiration. This trade is going to cost us about $2.65. Ironically, that is about a little less than 10% of the stock's value, which I really like. Okay, 265 versus 2972. Yes, right where I like it. Within that little number there, there's a little nugget for you when you're looking for these types of trades. And so at 265 per spread on this, we could see on this stock typically. I thought I had it up over here. Bear with me 1 second here. I thought I had it up. Typically moves about 9% around earnings. If we do get a 9% move, we're making money in this trade. That's the key. So JP, man, that's really it. We're gonna try to keep this trend of successful trades. We've had successful trades going on for weeks now here on this show, and we're looking for Bath and Body Works to be another one of those winners.
Yeah, I think people are really enjoying the whole straddle and strangle breakout kind of concept. You said we're coming to the back end of earnings season, so once we get through that, I assume that you'll be able to start talking to us about some income trades.
Exactly. Although we do have earnings going into December, some big names that go into December. We will start having trades where we focus on quiet consolidating stocks. Usually after we get through the heat of all the economic activity related to earnings announcements, stocks will tend to consolidate, and that is where we put on some delta neutral strategies that take advantage of a stock that really doesn't go anywhere or is churning slightly higher or churning slightly lower, and we're looking to capture some profits from that type of activity. So yes, we're going to be the holidays. I love trading delta neutral for income around the holidays because we have so much downtime, with weekends. And then, for example, this right now in the next 2 weeks, we have a weekend coming up, obviously, and then a short trading week. Markets are closed on Thursday, very light trading on Friday, and then another weekend. So a lot of time decay occurs around this time, and that's why it's great to trade delta neutral income strategies as we go into the holidays.
All right. Well, that's awesome, Jeff. We'll look forward to seeing how that trade goes for this week and hearing a little bit more about some income strategies in weeks to come. Brandon should be back with you next week, so I'm sure he'll follow up with you on how the trade went. But thanks very much for being on the channel. It's so great to have real traders using the Hub platform and showing people what can be done with the tools. So we appreciate you being here. And with that said, thanks everybody for watching. Remember to like and subscribe to the channel if you're enjoying the content. If you've got any questions for Jeff or for anybody else that you see on the channel, please remember to drop them in the comments and we'll come back to you. So with that said, thanks very much. Have a good week. Talk to you soon.